Hi, everybody, and welcome to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. Today, I'm going to take a more detailed look at the fair market values, or the FMV measure of the FANGs. Fair market value is a proprietary measure that we use to determine the intrinsic value of a stock based on our methodology, and it can often provide warnings for stocks well in advance so that you know when to buy and when to sell. When it comes to the FANGs, generally it tells us that the FANGs are, over the long term, overpriced, and while they may be exciting, do not offer real value in the traditional sense. When we look at the fair market values of the FANGs, that, by the way, is that dotted line on the SVA charts, you will see that the degree to which the average FANG stocks exceeds its fair market value is approaching 50%. So the risks are clearly in evidence. Indeed, when we look at the very long-term SVA charts of many of the FANGs, the volatility is stunning, terrifying even. You need to know and to appreciate those risks, not only for the FANGs, but for every stock in your portfolio. Now, if you're interested in finding value stocks, not the FANGs, our methodology provides a clear visualization of what those stocks look like as well, and how much you could make if you find the right ones. We recently had a client webinar where we went over this with our clients. Many found it very educational and, I dare say, valuable. So to that end, we want to share this information with you, our non-client viewers, in a free public webinar that we will be holding in the near future. You will learn how to use our charts to find deep value stocks that, at least in our experience, can provide huge upside potential. You cannot sign up just yet, however, but stay tuned as details will be released very soon. If you're not a client but would like to watch the webinar on value investing, you can sign up by going to www.strategicanalysis.ca/pricing, and you will have access to the value investing webinar today. Of course, you will also have access to our entire suite of charts and valuation services that come with the service. So sign up now. Anyway, right now we need to take a closer look at those FANGs and what's been going on. But as always, before I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. Okay, let's start off with Amazon. And Amazon is It has broken support at its bubble price, and it is clearly heading lower. They had a very interesting quarter just last night, but in reading the fine print, it seems to me that it left an awful lot of interpretation to the reader. It was somewhat murky in my view. Now, I said that I wanted to take a look at the potential of Amazon, and to do that, I look at the fair market value potential part of the chart over here, and you can see that the downside risk here in this stock just to get to its fair market value is minus 52.76%. So this stock is not without its risk. And if you take a very, very long look at the long chart of Amazon, you'll see that it's had a lot of volatility in the past. Apple, same thing. It is slowly drifting down to its HB5. Now, Apple is going to be reporting on Tuesday. So this is by far and away not a definitive chart. They have been buying back stock, I understand, for something rather about $20 billion in this past quarter. So those structural lines are going to change. We'll see what happens next week here. By the way, when I take a look at the fair market value of potential of Apple, notice down here it's minus 46.13%. NVIDIA, having broken its HB6, which you remember was the very long-term peak on the stock going all the way back to its highs of 2000. Anyway, broke out temporarily, but that seems to be very much it, and the stock has broken back below its HB6 now. Now, the fair market value has been, and really this is the earnings trend, has been rising very strongly, but we'll have to see if that carries on, because this was due to a very strong second quarter when their margins were, I think, some 72 or 73%. It'll be interesting to see whether they can maintain that pace. Now, looking at the fair market value of NVIDIA, you'll see here that it is minus 0.58%. So they'd better get it right on this one. There's a lot of risk in this stock. Tesla has fallen now to its HB2, which is 12 times book, and has broken support. So we don't have a confirmation, that's our 3% 5-day rule yet, but we have evidence here that the stock may be wanting to head lower. And by the way, when I look at the fair market value of Tesla, minus 66.34%, well, you know how I feel about the risks in the electric vehicle market. Meta had been struggling to break out over its MSG price, that's 5.5 times book value, and so far has not been successful in doing so. You'll notice, however, that the fair market value potential of Meta is only minus 2.9%. That is the best, I believe, of all of the FANGs. Everybody else is much deeper than that. I know that the company is working hard to see if they can improve their profitability and get the stock back up to its previous peak, which is the bubble price, which it's hit 3 times before. However, it's got to break out first, and I wouldn't buy the stock until it can. Alphabet had been steaming along nicely. Look at that, it's surging right along its MSG price. That's 5.5 times book value, until it reported its earnings on the same day that Microsoft reported its earnings too. And it became very clear in looking at the two of them held up together that Alphabet has been its cloud business. It's okay, but it's nothing compared to how strong the cloud business for Microsoft was, and the two stocks just went like that. One up 5%, the other down 5%. Now, unfortunately, that down 5% for Alphabet knocked it below the mid super growth price, that 5.5 times book. Now, when I look at the fair market value, okay, this stock is only, and I emphasize only, 8.5% overvalued. So compared to most of the FANGs, you might consider this stock to be fairly cheap. However, the failure to hold at the MSG price is a concern. And the question is it now heading lower? Microsoft, as they say, they really had a blowout quarter. Sales were up 13%, and their cloud business just went absolutely gangbusters. And the stock, which had been drifting down to its HB1, that's 9.5 times book value, has sort of done not exactly a U-turn, but a slow saucer-like turn, and we'll have to see if it goes further. I had this stock as a sell. I think I would probably upgrade it to a hold, a low to a hold only, until we see how well this stock can perform. Finally, Netflix, it too had a blowout quarter. And what happened is that it propelled the stock powerfully up to its bubble price and over. However, you know that I have been concerned about the valuation of Netflix up here. And today the stock has fallen below that breakpoint again. So we do not have a confirmed breakout, and therefore my sell recommendation on the stock remains in force. Now, in summary, almost the one bright spot among the FANGs had been Alphabet, but it suddenly let go its grip on its MSG price. As I say, it transpires that Microsoft appears to have built a stronger positioning in the cloud business than Alphabet. The stock has now offered us an unconfirmed sell, so TBA. What's both peculiar and intriguing at the same time, Alphabet is only 2.9% overvalued using our FMV measure, while Microsoft would need a decline by 42% to reach its own fair market value target. So the apparent risks are very asymmetrical. Amazon reported last night, and the numbers are what you choose to make of them. They either beat the heck out of the forecast numbers or were horrible compared to last year in the last quarter. Any way you look at it, the sales growth was less than 2%. But who's counting? This is definitely not your grandfather's growth stock anymore. Save its very high market valuation. With a 52% downside risk, this stock bears monitoring. Apple will be reporting next Tuesday, so I'll not make any comment except to say that the fair market of this value of this stock is 46% down from its current price. We will not be hearing directly from NVIDIA for a while either, but the HB6 price, that's 33 times book, has not held, and there is a 48% downside risk to its own fair market value. Our new focus is looking for some market support at the HB5 price. That's 26 times book. So that's where you have to be watching now. Tesla has now failed to find support at its HB2. That's 12 times book. You know what my concerns are. That the electric vehicle industry has expanded too fast, is generally not profitable, and will have to consolidate like what happened to the early auto industry in the 1920s. With a fair market value which is 66% down from here, investors need to watch those structural valuation levels closely for support or failure. Meta is the stock to watch. Although I would not choose to hold it at the present, it is struggling to break out over its MSG price, without success so far. Like Alphabet, its fair market value is a tiny 2.9% below its current price and represents a glimmer of value. Now, I personally prefer to buy stocks that are trading at a good discount to their fair market value. But as a FANG stock, Meta actually offers good value. Netflix had a strong jump following its excellent third quarter and has leapt back into the bubble zone, but that appears to be temporary. Finally, Microsoft finally got its hands on Activision Blizzard. And by the way, on preliminary investigation, it looks to me as if that acquisition will be accretive to the overall Microsoft valuation. Sales have risen nicely, a marked difference from most of the FANGs, and the shares are holding in nicely now between their HB2 and their HB1 prices. I'd been hoping for a nice clean bottom at that HB1 price, but that may not occur. With some trepidation, I might upgrade the stock to a hold, although the fair market value is 42% lower than the current price. In closing, the general weakness of the FANGs, the powerful market leaders for so many years, is a concern, both for the outlook for this group, but also for the outlook for the NASDAQ index and the Standard & Poor's 500, which itself has been propelled upwards this year by the so-called Magnificent Seven. Plus, I would have to add Netflix. If the weakness in this group spreads now, more than any other time, investors need to have a solid grasp not only of the rewards that the market offers, but also the risks that are entailed. Capital gains taxes are far preferable to accumulating losses, which, as a former partner of mine at Scepter Investment Counsel once observed, make for some tough chewing. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday.